Hello, and welcome to the Ignite sponsored webcast, What Active ETFs Adoption Means for Sales and Product Strategy, sponsored by ISS Market Intelligence. My name is Peter Carnivas. We'll get started in just a moment, but first allow me to explain the player on your screen. On the bottom, you see our audio controls. The slide and bar allows you to adjust the volume, and the circular double arrows can be used to refresh your media player. Beside the audio controls, there's a text box you can use to submit questions to our panel. We encourage you to ask questions throughout the presentation, and please note all questions will be addressed anonymously. Beneath the video window, you see a series of tabs containing more information about our speakers. Now, allow me to introduce our moderator, Elizabeth Ferdy. Elizabeth is a journalist with many years' experience covering the industry and will be leading today's discussion. Liz?
Thanks very much, Pete, and good afternoon, everybody, or good lunchtime, or good morning for those of you in the US. I'm very excited to be here today to discuss our session, What Active ETF Adoption Means for Sales and Product Strategy, sponsored by ISS Market Intelligence. So it won't have escaped anybody's notice, unless you've been hiding under a rock, that passive strategies has continued to transform our industry. The investment industry is unrecognizable to where it was 20 years ago. Asset managers have lowered fees on existing fund products to compete with the popularity of low-priced index solutions and have launched a variety of new product wrappers, modeled and packaged solutions to compete or complement this trend. We've seen access to technology and different platforms also pushing on this, and fees are getting lower. This also has an impact on our industry more generally. But while these trends for many years have focused on the rise of passive and ETFs to gain exposure, we've seen a rise of active ETFs. Even though they've been around for a little while, we've seen a real shove towards them over the past couple of years. And so what we're going to do today is dig into the perceived advantages of the structure, which when you combine the ETF wrapper with active management, what does that mean? What does it mean for the client? What does it mean for the advisor? And what does it mean for the platform? So we've already seen that US ETF assets have actively managed ETF assets in the US have surpassed $1 trillion for the first time this year, which is kind of bonkers. So here with me today to discuss this phenomenon, we have Ben Doob, who is Head of Business at ISS Market Intelligence, Paul Santoro, who is Head of ETF and SMA Sales at Capital Group, and Dan Aronson, who is Managing Director, ETF for Client Product and Client Product Specialist at Janus Henderson Investments. Gosh, got that out in the end, guys. Welcome. Hope you're all doing very well. Ben, I'm going to dive in straight away with you because I know that ISS has released some really interesting stats on this, and we love a good stat. Why are we here today, Ben, apart from the fact we all like getting together? Why are we here? Why are we talking about active ETFs? What's happened? Why has this 1 trillion figure happened this year? Give us some stats. Give us some figures.
Well, everyone likes stats. So first off, thanks for the opportunity to be on the webinar today, and certainly appreciate the opportunity to join with Dan and Paul. I think it's going to be a great discussion. And I know the audience wants to hear directly from them as well in terms of some of the successes and a lot of the efforts they put into succeeding in this space. But I think, if I start with your question, I think, why we're here today, it's pretty hard to escape both the overall industry narrative and the attention that's being spent or being cast in the direction of active ETFs. I think it's a relatively unique time and relatively unique kind of subject matter in the sense that it addresses kind of a number of core themes related to value in the industry that have either been under pressure or have been harder to innovate around. And so, when we think about, oftentimes kind of like what are the three things that ultimately we're trying to look at, right? So there's the product landscape, product development, product management, product strategy. Really, do you have the right products, or are the products in the industry, aligned with what's going to be able to be successful? You have the professionals in the industry, what they want, how their value prop has evolved, how they're working with their end clients to generate value and ultimately build long-term relationships. And I think you have the preferences, both at that kind of professional level and at the investor level, which is what people want in terms of a personalized experience and what people want in terms of a investment management experience. And so when you think about products and professionals and preferences, I think when we look at this, what's unique about the time we're in from an active ETF standpoint is it's given, I think, asset managers an opportunity to create some products that either were new and in different disciplines than they had in some of their existing structures. It's allowed them to bring some of the features that I think from a preference standpoint and from a professional standpoint, people have wanted in terms of potentially better tax efficiency, better trading ability, better ability to slice and dice portfolio to see to the way they see fit, and still get active management as a result. And then I think ultimately, just from a preference standpoint, you have a lot of people that ended up preferring active management or wanting some level of active exposure. But as you noted, the passive and passive ETF really sort of rise has led to a lot of asset allocation and a lot of using sleeves to generate the right asset allocation and the right sort of investment discipline they wanted. But sometimes that came at the expense of being able to use that type of structure and getting active exposure. So I think all those things have kind of swirled together to lead to a lot of growth in this particular spot. As you mentioned, from a stat perspective, right, we have nearly 3x the number of fund launches or strategy launches in the active ETF space than we did in the mutual fund space in the most recent period of time. We've seen the growth rate kind of steadily tick up in terms of flows as a percentage of assets. And so while it's been a slow build over the last 6 or 7 years, the last couple of years have seen much more explosive growth in terms of net flows as a percentage of assets. And most importantly, we've seen those flows across different asset classes, whether it be equity, international equity, fixed income, and across different price spectrums within the vehicle. So there has been a good amount of opportunity. There's been a lot of new product innovation. And I think as we get, Paul and Dan's perspective, again, from my perspective, you look at it as a product development opportunity. You look at it ability to deliver a different type of value and more value to the professionals that you work with from a distribution standpoint. And ultimately, it's been viewed as a way to deliver on some of the preferences that investors have and a different way of getting them active management while still checking the box on some of those preferences. So we're excited about where it's going. It's not the only thing out there. And I'll mention, of course, alternatives and SMA and direct indexing and passive ETFs are still obviously very much in demand. But this is an exciting space where I think we've seen some exciting development, exciting successes, particularly from the firms that are joining me on the call today.
Thanks very much, Ben. Before we dig into your views, Paul and Dan, I just want to remind the viewers at home, you can dial in with your questions or send them through the platform that Pete has outlined earlier. We won't. I won't be telling anybody who has asked the question, so you have your full confidence there. I'm not going to be saying it's so-and-so from this company. It will just come through as a question, and I will try to put as many as I can to the panel. So, Paul, I want to ask you, in terms of the asset management, in terms of what it is for the asset management community, we know that if you're dealing with clients, the client is always right, but the client sometimes doesn't know what they want. And this is, I don't think it has escaped anybody's notice, and certainly we've done many of these webinars looking at margins and how active managers have to stay relevant and provide what they want to the client. Why are you here to talk about active ETFs today, I suppose, Paul?
Yeah, well, excuse me, Liz, thank you. And first off, thanks for having me here today. Pleasure to be here. So I think a couple of things. Number one, at Capital Group, what we're trying to do is we want to make sure that we are offering to advisors and their clients the vehicle or our investment management capabilities in whatever vehicle that they want it to be in, whether that's a mutual fund, an SMA, or now an active ETF. We are the largest global active manager in the industry, so it was a natural next step for us to enter this space. So we wanted to make sure that we were giving choice to the end investor and the advisor to make sure that they could get what they were looking for in any wrapper they chose. And if you look at some of the stats, I'll reiterate some that have been shared already, but 39% of flows this year are going into active ETFs. So that means that the wrapper is becoming more comfortable for advisors. They understand it a little bit more. I'll maybe touch on this a little bit later, but education is a critical component to what needs to be done in the active ETF space. When you look at flows year to date, we're seeing them across all asset categories, and fixed income is one of the better opportunities, we think, in terms of capturing assets. So again, we wanted to make sure that we were giving choice to investors, and choice being the vehicle that they wanted to digest capital. And that's why we entered the space a number of years ago.
Thank you very much. Dan, I'm going to ask you the same question, but then kind of pull into how an active, for people who haven't maybe done the geek out and dug into this like we have, what's the difference between an active and a normal ETF? You know, the common garden ETFs that we all know, you stick it in an index and off we go to the races. So Dan, explain why you're here today talking about active ETFs, but also how you describe to my mum, who might be a client, how an active ETF is different to a normal one or an active mutual fund.
Well, I'll come back because I do think active ETF is a normal ETF, but I think you're really talking about index-based or passive. So appreciate the time today, and good to be on this call with you and Paul and Ben and share our insights. I mean, I think Ben and Paul sort of encapsulated a good summary at a high level from our perspective at Janus Henderson, and we would echo with what Paul said in terms of fixed income being that real interesting area of opportunity. So when we sort of stepped back and started building out our ETF capabilities, we did see an opportunity where we could blend active management within the ETF wrapper, charge a lower fee than traditional, perhaps mutual funds may charge, but provide access to areas that may be less trafficked. And so since we embarked on this about 9-10 years ago, we've actually over the last 3 years been #1 in flows in active fixed income ETFs. And it's really trying to be client-led, listening to the advisor community. We, of course, have our own insights and ideas around what might make sense, looking at our in-house capabilities and expertise and marrying that with where we think there might be white space within the ETF landscape. And so, but at the same time, that doesn't always translate to assets. So when we look at the growth in the number of active ETFs out there, it's actually surpassed passive, right, earlier this year, yet the median AUM for an active ETF is $62 million. So just because you launch something doesn't actually mean it's going to be commercially successful. And so I think you really want to be client-led within that landscape. From a standpoint of active versus normal or passive, I think there's a number of things. Number one, we have a few strategies. So our CLO ETFs, JAAA, JBBB, JMBS is our active agency mortgage ETF. If you look at that relative to the indices that they're looking to generate alpha from, our correlation is almost 1, right? So the idea can be you can have active that looks and feels intentionally like the underlying benchmark it's designed to track. And that actually was feedback we got from clients before we launched the strategy. Look and feel like the benchmark, but add your alpha from security selection. But then we have other strategies that are much more total return concept, kind of go anywhere in nature, that aren't necessarily tracking a benchmark. So, traditional passive to me, you could argue actually isn't even passive, especially in fixed income. You can't replicate fixed income indices. So there has to be some behind the scenes active decision-making around how I'm going to replicate this index. And so active management just takes it one step further. You can, again, have something that looks and feels similar, but really leaning into security selection expertise, or have something that really targets higher active share. But in terms of transparency, liquidity, tax efficiency, active ETFs are the exact same from that standpoint, from a passive as well.
I apologize for normal. I hope you saw I was doing the quotes, the normal, the expected, the I don't know. I'll just say passive ETFs. Let's have a dig into that then, because compared to an active mutual fund, if we looked at the difference between the two types of ETFs, what's the difference between a mutual fund? Because if it's an active ETF or an active mutual fund, is it like, I don't know, like I only recently found out that Coca-Cola and Diet Coke are entirely different recipes. It blew my mind. But is an active mutual fund entirely different to an active ETF? Are they entirely different recipes, or is one just a lighter version than the other? Who can help me out on that one? Give me the differences.
Liz, it's Paul. I'm happy to jump in there. In our view, they're really not different in terms of what we're trying to deliver. As I mentioned, we want to bring our investment management capabilities from Capital Group in any wrapper that the client may want. One of the things that we're hearing more and more every day, and have been for years, is how important taxes are to the end investor. So they don't want to pay taxes. So I think one of the biggest differences, so in terms of the underlying securities that are being bought and sold, whether it's in our mutual fund or an ETF, it's going to look and smell and feel the same. We're going to bring the capital system to that vehicle, but we are able in an ETF to use all of the levers, if you will, to work with authorized participants to wash securities out of a portfolio to hopefully not pay any taxes. Although I will remind people, I think people think that because it's an ETF, there will be no capital gains taxes. It is possible that you get a capital gain in an ETF, number one, but more often than not, you do handle that yourself. So it's when you purchase and then when you decide to sell, that's when the capital gain will be seen. But it is possible an ETF will pay a capital gain, but it is significantly less than a mutual fund. So if you think about it from our perspective, we're using the same money management capabilities that we have always used for over almost 100 years now. And we're just directing that in an ETF, and we're using the levers so that we can make sure that they are more tax efficient, because that's the number one reason why advisors and their investors buy ETFs, tax efficiency.
If I can just add, I mean, I think, at the high level, right, and Paul alluded to this, it's really about the strategy. The wrapper certainly matters, but you want to talk about what is under the hood. How does that fit with a client portfolio? How can an advisor think about it on behalf of their end client for positioning? But when you think about mutual fund and ETF, the tax efficiency, right, is definitely there from an equity standpoint. But I think a lot of advisors and even end clients think about fixed income ETFs as also this panacea from tax. And it really isn't the case, because most fixed income is driven by coupon, which is income, right? And that's not something the ETF can wash. Most fixed income ETFs, active or passive, distribute income monthly. And so I think that's something for just broad investors to be mindful of, that most of the tax efficiency is coming from the capital appreciation. And that typically is happening within the equity landscape. Now, of course, there can be fixed income appreciation. You think higher yielding type securities, and maybe the ETF via the in-kind sort of create and redemption can wash some of that away as well. But it's much more within the equity lens. The other, I think, big distinction in mutual fund and ETF land is when clients invest, they see themselves coming into a mutual fund at NAV. And sometimes they'll see, right, the bid offer spread in ETFs. What's interesting is when a client comes into a mutual fund, that transaction cost that you don't see is absorbed by everyone within the mutual fund. Within an ETF, the way the creation and redemption works, clients are only paying their own way in or out, regardless of what other investors are doing within that ETF. And so I think that's helpful when, especially in a volatile environment like April, where there might be more redemptions than normal, people often think, well, now it's trading at a slight discount to NAV or what have you. Am I going to be impacted by that? And it's really the people that need to get out for whatever reason, tactical, strategic, that are bearing that cost within the ETF structure, as opposed to in the mutual fund. If they sell, right, the remaining folks that stayed in will absorb that transaction cost. So that's a question we get frequently. So I also wanted to delineate between the mutual fund and ETF structure.
Mm-hmm. Ben, I'm going to come to you and ask, as a cynic would say, that if people look at the landscape, if I'm a client and I'm coming to say, well, how can I invest? I want to go to an active fund, but I don't want to pay for it. Can I just do the active ETF? Isn't that going to be cheaper and get the same results? Is that something you hear? Because the explanation about the transaction fees and everything is if you don't really understand the technicalities of it, like, oh, just tell me what's the cheapest way of getting the best investment return. Is that a very cynical way of looking at it?
Well, I think I would echo what I think has been mentioned already in different answers first, which is like when we look at number one, if you're looking at like why would you choose, just conceptually, why would you choose, either an active or a passive ETF? I think it's interesting that the top two reasons are still the same, right? Which is tax efficiency and fees. That's top of mind from people, right? I think that then the third is active or passive. So it's back to like, it's still the strategy. And I think that was what was mentioned before, is what's the thing that you need in the portfolio. But it's I think important to look at holistically, right? Which is, the portfolio has to be built out to cover what that investor is trying to achieve from an outcome standpoint, which will usually involve a variety of either different vehicle strategies and allocations that get them to whatever that outcome in theory will be. And so for a sleeve or for a particular strategy, does someone want the cheapest exposure to it? I think, again, that's going to come back to client preferences and what they're looking at. I think you would argue that in many cases, people are willing to pay more premium prices, in some cases for different strategies they feel gives them differentiated exposure or private exposure, what it may be. But I think it's important to note in that fee construct you just mentioned that we've seen success and in the active ETF space. When you look at the fees, you look at the fee levels that ultimately have ended up, kind of from an asset rate perspective, playing out in some of these bigger success stories. I would argue that, depending on aspects, you're not seeing necessarily a massive haircut in fees depending on what you're looking at. There are cases where you are and there are cases where you're not. But I think it comes back to that mix of, can I get some of the vehicle's benefits, mainly tax efficiency or perceived tax efficiency? Can I get the ability to carve out and put that into a portfolio in a way that's cohesive with the rest of what I'm trying to achieve? Obviously, I'm getting, I think an attractive fee level. But it may not necessarily be, the same situation as where you're looking at just a race to the bottom on fee level. You're still willing to pay for that active exposure. And so I think when you look at, even in the space that was just mentioned with something like JAAA and the ultra short space, there's a pretty wide variety of fee levels in there, some more, some less. But there's some very specific approaches to the strategies people are looking for in terms of the exposure they want in that particular asset class, and as a result, that drives into that strategy. So I'd say fees are important, but again, it's in the context of the vehicle gives you some benefits that you want from an efficiency or tax efficiency standpoint. But in the active ETF space, I think it comes back to, I think we're going to talk about a bit, is the engagement from a distribution standpoint, the engagement from an education standpoint, and ultimately the marrying an active strategy that with the outcomes that clients are looking for, I think is the most important factor in the decision making.
Thanks very much. And we've had a question in, a really good question, so thank you. We've had quite a few, but I can't do them all. But this one I think is a really interesting one. How do you guys view or handle the risk of cannibalization from your traditional mutual fund business if you offer similar or same strategies, both within mutual funds and active ETF wrappers? We're going to come on to this in a bit more detail a bit later. But Dan, how do you gauge whether if we launch this, then it might take all the money out of that?
Yeah, no, it's a great question. And it's something we grapple with internally all the time. I mean, I think how we've been approaching it is, as I alluded to earlier, still looking for that white space within the ETF landscape. Now, admittedly, that's getting harder and harder given the proliferation of active ETFs, especially going back to 2019. The SEC made it a lot easier for issuers like us to come to market sooner with active strategies. And so that's where you really started seeing the proliferation. But, from our standpoint, we haven't been in the business of thinking about cloning or converting. At this point, we have a very mature, robust mutual fund lineup that we think, our CEO often talks about protecting and growing our core, and that mutual franchise is extremely important to us. However, within the active ETF space, there's a lot of opportunity, especially when you look at the advisor community and ETF model firms, et cetera, that really want precision in their control of asset allocation. And so that's what we've been focusing on, is giving sort of building blocks, if you will, within the portfolio construct on the active ETF side, as opposed to our mutual funds, which might do that in some sectors, but are generally a little bit more holistic in their approach to managing capital. And so far, we've been able to find that they can mutually coexist because we still have enough of that white space in terms of launching what we think are more innovative, differentiated strategies in specific areas. But it is a challenge, right? It is something that we are constantly thinking about. And it's not to say over the next several years, we won't be thinking more about which strategies might make sense in an ETF wrapper. But at this point, we still have plenty of runway with new ideas and concepts, including being client-led around these new ideas, to not have to worry about that aspect as much.
Thank you. And Paul, I want to ask you a similar question, but also delving into the opportunities of the active ETFs, and it's what you just mentioned there now, the composability, I almost say compostability, I spent all weekend in the garden, the composability of the vehicle. So creating building blocks of portfolios, which isn't as easy to do with mutual funds, just to the entire makeup. So how do you approach the same question, this cannibalization risk, but also how do we approach this composability and other really good, I'm going to have to get back to the garden, and other good opportunities that active ETFs offer?
Well, you have difficulty with that word, and I have I find it difficult to say cannibalization. So we're in the same boat. I would say this. Number one, not all cannibalization is bad. And I think that's the first thing an asset manager needs to get their head around, because advisors and investors are making a choice. And that choice is that they want to pay lower taxes, and ETFs offer that choice to them. So I could give you numerous examples over the last 3 years, but there were times when a advisor was going to roll out of an American fund, one of our mutual funds, and move it to passive ETFs. They didn't realize that we had ETFs. Now, that's the other learning experience, by the way. We've been in the marketplace for we're coming up on our 4-year anniversary next February, so we're a little over 3 years now. And today, still, we are doing a tremendous amount of education on, number one, that Capital has ETFs. We branded them Capital Group, so a lot of people know our mutual fund lineup as American funds. Capital Group is our ETF lineup. So number one, that we have ETFs to offer as an alternative, so that money doesn't leave the complex. And that's why I say not all cannibalization is bad. We've had a number of instances where somebody was in one of our mutual funds and they were going to roll out. We were able to keep those assets here at Capital. Otherwise, they were walking out the door. Number two, we do a tremendous amount of education. It still surprises me today, 3.5 years in, around the ETF structure and the wrapper and the tax efficiency of ETFs. And that is something that I think is going to continue for a long time. So again, not all cannibalization is bad. I think it presents an opportunity for us as an organization to keep assets in-house where they would have walked out the door if we didn't offer the ETF wrapper.
If I could quickly jump in on that too, I think just observation point from benchmarking a lot of advisor practices, right? So the firms, like those on this call, right? The more successful sort of trajectory we've seen over the last couple of years, right? You've seen the sort of percentage of the client base that only uses mutual funds from a certain provider come down, but you've seen the percentage of the base that uses a combination of vehicles go up. So the mutual fund only client maybe has come down, but you've seen more mutual fund plus ETF or mutual fund plus SMA or mutual fund plus ETF plus SMA. Right. And so you have to ask yourself, I think, two things, right? Like, are the strategies you're bringing in play via those vehicles the same types of strategies that yield engagement, that yield these educational opportunities, that yield the type of relationship you're going to build with these professionals over time as a provider, as opposed to being just a commoditized, purchase that they may make in the portfolio. And thus it's less about the brand, it's less about the engagement, and it's more just about, I need that index exposure in this sleeve. So I think active combined with these vehicles gives you opportunity to build that relationship over time, even if the vehicles look different. So to the point about customer lifetime value, or just in general, the cannibalization risk, if you can offer more capabilities to the client and keep that client long-term and keep educating that client on the ways they can ultimately generate the outcomes, I think that presents a lot of positive upside. And for those firms, Capital Group included, when we see that trajectory, where we see the ability to use multiple constructs to build relationships with those clients over time. And so while there is obviously cannibalization risk, there's also the risk that, to the point, you lose the client entirely because they went to a different philosophy. And here, if you can offer better or enhanced ways to continue building the portfolio you feel like you need for your clients to generate the outcome you need, I think it's a real opportunity. Now, that doesn't cut that way for everybody, but for the people that have the combination of the distribution capability, the performance perception, and the ability to have that holistic conversation, it's proven to be, I think, a great opportunity, despite some of those, on the surface cannibalization risk.
It's a great point, Ben. If I could add one other thing, Liz, if it's okay. The cloning thing, Dan brought up cloning, and we made a decision as well to not clone. And there's a myriad of reasons to do that. But the most important one is that we wanted to bring new or different investment strategies to the marketplace. So here's the way I would explain it. If you look at our lineup, we're really shooting to be at the core of a portfolio. That's first and foremost. So every one of the ETFs that we've built are designed to fit at the core. They do share some characteristics that look the same as the American funds. And American funds is a very well-known lineup in the industry. Advisors have a tremendous amount of trust. The way I think about it is think about cousins. I have a cousin. You can't tell because I'm sitting down, but I am maybe 5'9", although I said for years I was 5'10". I think I'm more around 5'9". But my cousin is more like 6'6". We share similar DNA, but we're not the same. But our DNA is fairly similar. So if you think about the American funds mutual fund structure and you think about Capital Group's ETF structure, they are not clones, they are cousins of one another, and we're trying to deliver that at the core. So, and I think it's an important component and differentiator. People need to know and understand what they're buying, and in doing it in the way that we've done it and trying to fill gaps in the lineup, they know and understand from their history working with the American funds that they're getting something similar that they can count on.
Thanks very much. I'm just thinking about my own cousin as well. She's vastly different to me in many ways, positive and negative. She doesn't know anything about active ETFs, though, so you don't get her today. Following on from that, because we've had a question in, and looking at that specifically, is there a worry that active ETFs transparency will give away the secret sauce? Now, I think you've explained that really well, Paul, but how do we look at this for the asset managers, then for the investment managers, if you don't do this, if there is this concern that if I, even give a little bit away, then someone's going to come away and replicate my portfolio or whatever. What's the danger, Ben? And what's at stake if investment managers, because it took quite a while for even some of the big guys to get involved in ETFs and taking this active ETF step. What's at stake if this whole area, which seems to be growing enormously, is ignored or not given a clear focus by sales or marketing or product or whoever else, in the C-suite? And I don't want to talk about the advisors and the end client, but for the managers, for the guys, like not the Capitals and Janus Hendersons, but the peers, if they haven't got into it yet and they're like, I don't know if I can be bothered, what do they risk by not getting involved in this growing sector?
So I think I can take that first. Look, I think, I don't need to recite a lot of stats about the flow, the net flows out of active mutual funds, right? So I think everyone's staring that in the face because there is product innovation. Now that I think what's at risk here, right? I think it's important to differentiate between is an active ETF kind of a relative unicorn sort of product relative to other things. I wouldn't classify it that way. I would classify it as it's an evolution of the ability to get active strategies, right, while getting it through a vehicle that offers some perceived benefits by the client base. But it, like anything, right, needs to be put into a holistic, portfolio approach. So if you're a manager who is looking at this, I think the first question you have to ask is, do I have strong, and it was mentioned earlier, do I have a strong kind of trust factor with clients today? Do I have a strong performance perception, performance track record with clients? Two things that are very important from an active management standpoint. And number one, how big is my client base today? Because I think you have two things, right? With the existing client base who's looking for active management in certain parts of the portfolio and wants to get it in a construct that they feel fits with what they're looking for, which may be an ETF, then they're going to think about who are the firms that I trust the most that have the best demonstrated performance track record, et cetera. But there's also many people who are looking to move, as was mentioned just now, just saying, look, I'm in active mutual funds. I think I should move to passive ETFs. Those are potential customer acquisition opportunities that are out there if you're able to engage and show that you can have active strategies in that space with price levels that are going to be amenable to you and get the benefits of the ETF structure. So it's customer acquisition that you can grow your base through places where maybe you didn't have an availability before. So I think there's two ways to look at it, right? You can capitalize on your existing credibility from a performance, track record, and trust standpoint to launch new, tangential or newer products or newer types of products in this vehicle and continue to expand that client relationship and retain that and grow that. But then for other managers, I think the question is, can I get better or accelerated customer acquisition in this period of disruption by offering strategies that are in some of these, I think, wrappers that are gathering a lot of attention on platform and gathering a lot of attention from professionals looking to change or quote unquote modernize their portfolios.
Yeah, and I think Ben touched on something also there in terms of leveraging sort of the existing infrastructure, the track record, right? Because when you're launching a new ETF, especially if it is total green space, you don't have a track record. So that trust factor becomes really important with clients that you've captured more holistically and really engaged with. And so when it comes to a new launch or a new strategy, you already have this sort of pedigree of other active ETFs that you can rely upon, or that the client advisor community understands where you're coming from, how you're approaching it. And what we've been trying to do is not necessarily reinvent the wheel, but maybe, a team that's running a sleeve of an existing mutual fund, we want to carve out as a dedicated ETF. And so while we might not be able to specifically point to that strategy standalone as having a longer track record, there's at least that team track record, that team familiarity. But I think that is part of it when you're thinking about breaking new ground, so to speak, or thinking about launching an active ETF. Generally speaking, it is helpful to have at least some familiarity with the asset manager, with the specific teams that are running the strategy, even if that track record itself on a dedicated vehicle basis hasn't yet existed.
Yeah, and I would just quickly say too, it's just coming back to, we're talking about active here, so we're talking about strategies that need to be communicated, and the value prop and the sort of philosophy and endeavors of that strategy really need to be clearly communicated both at point of sale and through the relationship management process. So it's not just sort of evident what it is, right? And so that brings back a lot of the lessons learned, I think, from mutual funds, right? Which is a lot of the things you need to do from a marketing, distribution, and after the sale support standpoint apply. Just because it's an ETF wrapper doesn't change the fact that I think those core principles and core trust and credibility building factors are still going to be paramount over time.
I mean, what are the challenges? Because we've spoken about a lot of the opportunities, but there are challenges. And as you're saying that, we said that having a lack of track record or going into a brand new area or breaking new ground. And let's be honest, as the days unfold, there's more and more investment opportunities everywhere. I mean, the world is different from yesterday. It's going to be different tomorrow. So there is going to be new opportunities. How do you work with advisors? How do you help them to explain to their own clients what's going on and what these opportunities are? Because, the world, as I said, the world changes in the way that we want to invest for the future. Our objectives change all the time. So I don't know, Paul, how do you work with intermediaries and to say this is, you might have thought this is this, but actually I need to explain to you in a way that, we both benefit?
Yeah, so it's a great question. I would say I'll keep this at the advisor level and how we're working there. First off, in just little over 3 years, we've done 82,000 meetings with advisors related to active ETFs, which is an astonishing number. But in my opinion, we are just at the tip of the iceberg. And the one thing that I mentioned this earlier that keeps coming up is education. And it's education on the wrapper, it's education on tax efficiency, and helping advisors understand how an active ETF can be tax efficient. They just, for years and years, just took the word of the Vanguards and BlackRocks that an ETF was tax efficient. They never really dove into the mechanics of why. We have to dive into those mechanics and help them understand that passive and active doesn't really matter. You're using the mechanisms at your disposal. So there's a lot of education that we are doing. If you think about our distribution model, we are very much in belief of the generalist specialist model. So we've got well over 100 Salesforce members across the country that are devoted to working with financial advisors. They're, though, responsible for distributing everything that we offer, from mutual funds, ETFs, SMAs, retirement plans. So they have a lot on their plate. We have aligned them with specialists to come in across the country and help educate and train advisors. And we believe in that model. We think that's a model that's here to stay for a long time. Again, as I mentioned, 3.5 years in, we continue to focus in every single meeting on education. And it's happening every day. And a fixed income space is a great example. If you look at mutual funds, advisors prefer active in the mutual fund wrapper. About 75% of assets sit in active management strategies in a mutual fund. On the ETF side, it's actually the opposite of that. It's 25% sit in active strategies, where 75% sit in passive. Advisors don't understand really why they would use ETFs for fixed income. So we spend a lot of time on educating that, and we're starting to see those numbers uptick as well. So really, it's the biggest challenge in my mind is how do you get to advisors and help them understand, because they have this belief that tax efficiency means passive. So we need to get out and educate as much as we can.
Yeah, and I can't underscore, education enough. So echoing everything Paul said. So I lead the ETF specialist group here at the firm. And so we also subscribe to generalist specialist model. Our sales force across the country, right, is covering all different wrappers. And from our standpoint, especially as you're launching active ETFs, right, with full transparency, equity land is fairly straightforward in terms of you can go onto the website, see what the positions are, and you might not understand exactly what our strategy is, but people know what Apple and Disney and NVIDIA is. When you go into the fixed income website and you see all of the QSIPs, it is an alphabet soup of I have no idea what you're doing under the hood. And so we've spent a lot of time over the last several years. When we launched our CLO ETFs, most people didn't really know what a CLO was. They thought it blew up in 2008. That was very, very different. That was a CDO. We're not going to spend time on this webinar today on educating the differences, but from our standpoint, it was of paramount importance to educate not only on the wrapper, to Paul's point, so we have white papers around the ETF structure, liquidity, and really unpacking that, but then at the strategy level, what is the strategy all about? What are these QSIPs that I'm looking at? What is a CMBS security? What actually is the collateral? Here's a picture of a building that we own. Things like that. Humanizing the portfolio in our mind, especially on the fixed income side, is really critical. And importantly, it's not just prior to the sale or at the point of sale. It is ongoing. The world is evolving, as we've all seen all too well over the last several months, and things change. And understanding unintended consequences, unknown unknowns, how that impacts portfolio, all of that can be teased out in advance to clients, to advisors, so long as we have the educational framework in place. Again, both at the strategy, higher level asset class, but also really unpacking what exactly is under the hood. And importantly, probably most importantly, what can go wrong? What are the real risks within the strategy, and getting people comfortable with those risks, even before understanding the positive attributes that we all think our strategies offer from an active standpoint. So education can't underscore it.
I would just add too, I think just on both of those notes, right, the deployment of specialist resources, certainly a hot topic as well, right? Finding the right balance, making sure you have the right structures in place to have a coordinated effort, obviously, of engaging and building these relationships to the point whether you're delivering education on a certain topic or not. But I think, again, when we look at from an advisor perspective, it's glaring. Like the biggest challenge of working with specialists is a lack of understanding of that individual advisor's business, right? And so you can have an incredible amount of product expertise if they want, but the challenge and the perceived notion that you don't understand my business, right? You understand the product, and you can talk all about the product, but do you actually do you understand the business I'm running, my practice I'm running, where I'm looking to achieve? I think that's what's differentiating the success stories from not. And so to the points just made, it's not just a transactional meeting, right, where it's like I need to come in and just talk about a product for this period of time, but it's the diligence and the ongoing effort to build that relationship and understand that relationship so that the specialist isn't just a product expert, but they're actually an expert for how that product could fit into the potential outcomes they're trying to achieve. And that's easier said than done, and not, the industry is not littered with like all success stories of that. That's the challenge that we're seeing right now. And I think the second piece I would just mention on that is that historically there's been, again, I think to the point made, sort of this assumption that, well, like if I know mutual funds, then I know ETFs, right? If I know the strategy, then I can go in and talk about these things. And I think that, as has been pointed out here over this call, this education component in the active space, in an ETF, it's big and it's required. And I think it is, I don't want to say overlooked, but it's a big differentiator, your ability to both kind of personalize and explain the implications of moving to a strategy like this. And oftentimes it was because, well, I need really specialized stuff for an SMA or for alternatives. But in this case, I think there's still an educational component here that really differentiates players like those on the call have engaged with their clients, and some of the missed opportunities that may also be out there.
Thank you very much. Right, we have less than 1 minute to go because we've, well, as I said in our before we started the call, we could do 2.5 hours on this and still not cover it all. So, but we've done our best. So thank you to everybody who sent in your questions. I do have a quick one about volatility. It seems like mutual funds are less volatile in terms of monthly flows opposed to ETFs. You've got, I suppose you could argue, the double layer of volatility within an ETF. I don't know, but again, does this fall under the education piece? Like you have to explain to people who are selling the product to their clients, and this all kind of falls into what you should expect. You shouldn't just expect passive. You shouldn't just expect an active mutual fund. These are a new animal that you have to get to learn.
Yeah, I mean, in interest of time, I think volatility of flows, right? First off, if we're looking on a percentage basis, obviously the active ETF base is very small, so you're going to get higher percentage values relative to actual dollar flows. So that's often one thing you want to look at. I think the second piece is certainly baked into that long-term legacy mutual fund asset base. There's a lot of factors like unrealized capital gains that are going to put some buffers on kind of what happens in terms of people's actions, and the fact that the ETF vehicle does work relatively well in a lot of models, and particularly constructed models in the RA space where they can decide to make some more tactical moves in and out. I think we will see some of that stuff lead to, on a percentage basis, some ups and downs. But ultimately, I think that here you have to look at as the portfolio overall. And given the portfolios now are tending to be a mixed bag of vehicles and strategies, you got to look at it more holistically across the board relative to just one vehicle. I think it's the strategies and the portfolio makeup that are the more important markers over time. And I think providers are going to keep trying to innovate and keep trying to the point earlier, what does the client need and what are all the different ways that I can deliver that to them that meets their preferences? And there will be some inherent ups and downs by individual vehicle within that construct. But if you're delivering holistically across the sets of choice and delivering your strategies through those choices so that you can cater to their preferences, I think that the ultimate outcome will be more long-term positive.
Fantastic. And that has pretty much answered your shot at the final question, the bucket question. How do you see active ETFs impacting the industry over the next decade? I think you've covered that one, Ben. So, Paul, I'm going to ask you, how do you see active ETFs impacting the industry over the next decade? And you've only got a couple of minutes because we're already over time.
All right, fair enough. Thank you again for having all of us here today. So, it depends what study you look at on what the asset size of the ETF industry will be in the next decade. I've heard numbers up to $40 trillion. It doesn't really matter what the number is, but it is almost all the percentages are in the same ballpark, which is that active will represent somewhere between 25 and 30% of assets 10 years from now in the ETF space. So if you think about that, you're talking about 10 to $15 trillion market over the next number of years. And that is a very exciting opportunity for us. I do think where growth is going to come in a couple of key places. Number one, models. I think that models going forward are going to be the place to capture assets. Advisors are looking to outsource, and models are a great solution to do that. We recently launched models in the early part of this year. They're just starting to take foothold. And I think that's going to be a big driver as you get toward that 25 to 30% adoption in active over the next decade or so. Models will be big. And then number two, I think the RIA space will also be big. They have predominantly used passive in the RIA space, but you're starting to see a major uptick in terms of active in portfolios. And some of the numbers that we see here at Capital Group, almost 23%, 24% in terms of overall portfolio is now being allocated to active ETFs. Still using passive, don't get me wrong there, but they are allocating more to active now that they have choice. So to me, the biggest drivers going forward, models and the RIA space.
Brilliant. Dan?
Yeah, I would. Yeah, from my perspective, and I touched on this earlier, right? Active ETFs are still kind of little bit in their infancy, right? They've been around for a long time, a few of them, but a lot of them are newer and are developing that track record. And I think as that track record continues to season, that demonstrable alpha that they are hopefully generating relative to passive can continue to take share. We've been the beneficiary of that within our fixed income lineup. And we think that for the broader community going forward can certainly continue growth. I completely agree. Models are, sort of the panacea, if you will, from an ETF perspective. A lot of our biggest clients are some of the ETF strategy firms out there. But when you look at, in terms of our internal development, we've had multi-asset. We launched dedicated fixed income ETF portfolios over the last year as more and more people get comfortable with UMA type capabilities where they could pull active ETFs, SMAs, et cetera, and have them all under one roof. They can choose different asset classes for their model selection. So we think models will certainly be key. I also think there's this blurring of the lines with alternatives, right? We didn't really touch on alternatives, obviously, as active ETFs, but not that you're going to be able to put completely illiquid into a liquid wrapper. That's not what I'm getting at. But to capture the spirit of lower correlation to traditional equity and fixed income benchmarks and indices, the development is happening because it has become the wrapper of choice, ETFs. You're seeing a lot more of that innovation and insight being put into the active ETF wrapper. And so I think you'll continue to see alternative-like capabilities that can continue over the next several years and really drive growth in the space.
Brilliant. Thank you. Ben, we've already got a busy decade ahead with all this stuff coming down the line from these two guys. Is there anything you want to finish off with?
I think those are great points. And I would echo the fact that, particularly when you go up into the higher end of the managed asset levels in the RA space, or certainly, in the wirehouse, but certainly the RA space, you see a lot of propensity to use ETFs, both passive and active, right? A lot of propensity to increase business in the ETF vehicle, the RA space, as we mentioned. I would just note that, again, with technology, right? And we think about models, we think about trying to get these outcomes. The other factor to look at is how all these different vehicles will fit together in terms of the influence technology will have on the ability to personalize the portfolio, right? And again, does it come to the products in the sleeves? Does it come to some level of kind of direct indexing or some sort of personalization that also disrupts or changes the way people are achieve those personalized outcomes? So I think those are factors we look at. But over the next decade, right, the ability to get active strategies that you believe in, that you trust, and that you philosophically think are going to deliver the types of long-term returns you want, and get that in a vehicle that you feel matches up with some of the other exposures you may have in your portfolio. I think we're seeing that perception and that the buy into that idea really picking up and creating opportunities for those that are bringing strong strategies coupled with strong education, distribution in the market, and educating people on the opportunities that are in front of them with it.
Brilliant. We are well over time, so I hope everyone in webinar land doesn't mind us taking a bit more of their day. So thank you very much, panel, for being here. Ben, Paul, and Dan, thank you for sharing that with us. Thank you all for your questions, everybody in webinar land. Thank you to ISS Market Intelligence for sponsoring the webinar. I'm sure there's lots of interesting stuff on your website, Ben, that people can dive into under active ETFs. I have read some of it. It is it's very weighty. But thank you for joining us. There is a replay available, and Pete is going to tell you all about it in a moment. And thank you for joining us, and see you again at the next one.
Thank you.
Thank you.
Thank you.
Thanks, Liz. And just echoing Liz's thanks for everyone for attending today's webcast, to our panelists, Ben, Paul, and Dan, as well as to you, Liz, for moderating. And to our audience, please keep an eye for that email that Liz mentioned that will be access to the archive. And a very big thank you to ISS Market Intelligence again for sponsoring today's conversation. Thanks, everyone. Have a great rest of your week.